Happy Friday. Thanks for joining. We're gonna do a little Q&A. Let's dive right into it, shall we? And get an idea of kind of what we're gonna go after. So let's just walk through the agenda. So very first, we are going to talk about 4 questions to ask and answer before you put on a trade. Then we're gonna do a random-ish playbook example. So you can prime the pump for this. You can put in the chat or the Q&A. Give me a date and a product. So do the math to make sure it was actually a market day, and then we'll go from there. All right. So date and a product, and then we'll do some Q&A. I've got several questions that are queued up that were submitted first. So we'll go through those first. And then if you have any additional questions that come up and you want to go over, throw those in the Q&A and I will add them to the list. And then we'll talk about a couple next steps. Okay, make sense? So with that, let's dive in, shall we? So let's talk about these 4 questions to ask and answer before you place a trade. Whenever I place a trade, or if I'm working with a trader and we're trying to develop their playbook, we always put trades in this framework. And many of you will hopefully have known these 4 questions. It's really the only thing that I could give you to absolutely guarantee that you'll be better tomorrow. There's so much about this business and what we're trying to do that's built around process, and this is just a really, really good process. So what are these 4 questions that we ask and answer? So one, what is the opportunity or target? So think back to trades that you've taken. How many of them did you enter knowing where the destination was first? So what's the thing that drives it? Is it the target or the trigger, basically? So we don't take trades, and any trader that I work with, we're trying to develop their playbook. We work towards a framework where you're not taking an opportunity or a trade unless you first determined, never guarantee, always a hypothesis, but you can have a good hypothesis. Where do we believe that price is going to go? And that's important because then I can right size the risk. It releases you from this arbitrary, every time I take a trade, I'm going to do X number of points of risk, or a certain percent risk. Those are good risk management protocols within a Monte Carlo simulation, and they'd keep you from losing your bankroll at the casino, but they don't actually represent any type of edge because the market does not present the same opportunity every time. Okay, so but how do you get to a place where you can right size the risk relative to something? You have to right size it relative to the opportunity. Got to know where that is first. Now, once you're in the trade, you've identified the first 2. The next one, and again, you have to answer this before you take a trade. What would tell me that I'm right? So if I'm going to take this trade, how should that go? What would be the behaviors, the price action, the time, the acceleration, the velocity of how this trade should work out? When you have a really good playbook trade, you can almost close your eyes and anticipate what that trade should look like and how it should play out. This is so critical because it shows a depth of experience around that trade, as there are, they're rarely just like beautiful textbook examples, but there are examples in markets where we see similar behaviors over and over again that we can exploit. And it can help you stay in that trade and get to that target. But then at the same time, we have to answer the question is, what would tell me that I'm wrong? So if I have a picture in my head of how it should work, how should it not work? What would be an early sign of this isn't working the way that I'm expecting it to work, and I should get out of it? And why do we ask this question before we ever express an idea? It's because the brain, I don't know if you knew this. I'm sure you've encountered this, but our brains do not like to be wrong. And when we commit risk capital, we are engaging a part of our brain that doesn't want to be wrong. And so if I haven't primed the brain beforehand to take the appropriate action if things are not behaving as intended, it gets much more challenging to do that in real time. Because there'll be this part in your head that's like, well, but what if it turns around? Or but what if it comes around? But what and that's the stuff that can really, I mean, ultimately will impact what results you get, but it's going to impact how you think about the results that you get, and even how you think about yourself. So this is a framework that, when applied, can really put you in a place to succeed, regardless of what time frame you're after, and what product you're looking to do. So those 4 questions, we talk about that because this example we're going to look at here in a second, we're going to use and apply these 4 questions. And I have a strong conviction. I mean, I'm not a big fan of absolutes in just about anything, and I have strong conviction. So conviction is a way that you can have a pretty strong opinion but be open to new information. Is that if there's no target, there's no trade. So it's really, really easy to get sucked into action based on movement within a chart, but try to pause the brain and go, whoa, wait, but where do I believe this is going to go? Then how do I think about whatever this movement or trade is? Okay, so with that, let's pick a random date and a random product, and let's see if we can find a playbook trade in that. So someone put in chat, a date and a product, and and the only criteria would be that it would be NASDAQ, ES, Russell, crude oil, gold, soybeans, Bitcoin. That would be I mean, that's the ones that I look at, and it obviously needs to be a market day. And what we're going to do is we're going to look for playbook opportunities. And so what I mean by a playbook opportunity is I have this is my playbook. These are 4 question setups. So every one of these setups has an answer to the 4 questions that would have to be answered to be in play. And now, to be an effective market participant, you don't have to have like this many ideas in what you're doing. Like there's no requirement that you have that many ideas. What it does offer is the ability to have something to do. I mean, I like to have something to do, because my brain, left alone, will get in trouble. So what I like to do is I like to have these that I could express. If I have these playbook ideas and then I have 4 or 5 products that I'm looking at, I can typically find something to do, which can be really helpful and keep me doing a playbook trade, not just like clicking buttons. Okay. Okay. All right. So far I've got a submission for the ES on the 17th of June. Don't have any other. We'll go with that one. We've got InQ on the 13th. Okay, so we'll do the ES one because here's my caveat on ES. I do not often day trade the ES. So like my primary, while I'm always watching the ES, as I think if you're going to be in the equity space, you need to be looking at that. But I'm primarily looking at NASDAQ or Russell. But just to illustrate this and to know that there's not, let's look at the ES on the 17th. Okay, so we're going to jump into a replay. So let's go, we're going to turn off a couple things here that we don't need. Because these will not be helpful on that date. And let's go back to the, so we said what, 17th, and we're going to go to, so here's how we're going to do this process is we're going to start pre-market, and then from there, so we'll do a little bit of, we'll talk about like, how do I express a plan, right? Like what's the specific idea of narrative? Because whenever you're looking for a trade, so there's narrative in your plan, and then there's also like the execution of a playbook trade. Okay. So, and they're not the same. So having a plan and then having a trade are not the same. So we're going to look at what are just an expectation for this day. And I don't know. See, that was the. Let's check and was there any catalyst on that date? The 17th. So Wednesday was FOMC. So we're pre-FOMC is what we're looking at here. Okay, so let's get after it. So here we are pre-market, and let's also start with kind of a top-down of how I look at a market. And this would be like if I take a vacation, and I'm like, coming back to a market, like how would I, start and approach that? So I start here. And these are monthly profiles. So this is a 4-hour Heikin Ashi. But what I'm really looking for are the relationships of price to value across multiple time frames. So let's look at, a couple different references. So here's the last price. Here's the most traded price of the last rolling 5 sessions. Here's the most traded price of the last 20, and I believe also the last 90. I think that's right. Yeah, it's both. All right, so we're kind of in between these references. This is a monthly profile, the blue. These are weekly profiles. Okay, so here's the prior week's point of control. And here is the 5-day. So like the most significant references, if I'm coming into this day, because not every price is as relevant to the market as another. Make sure I'm showing external. Okay. So we have a naked point of control here at 60.91. That's a reference. We have a naked point of control at 60.30. Let me add that. And we're on Tuesday before FOMC, below or basically right at the most traded price of the prior week. So we have kind of, these are two significant prices. So here and here, and then here. Now, this is the overnight profile, and the red here represents the Globex or the Euro. I'm sorry, not the Globex, but it's the Euro initial balance. So the SPX options specifically start trading at the Euro Open. So you'll often find that we will respect one side or the other, or if you want to see the market kind of really move, we'll be neutral across that. Now, in recent times, you'll see certainly some examples where we're neutral across that, such as the world that we're in at the moment. But as I think about this, the prior day was a directional open higher, left some buying excess. We had developed value at that 60.91. That's where the 5-day was. So, I would expect that if we were above weekly VWAP, kind of what I call a pre-IB bias would be higher, and we're below that. So we're at 60.64. Which means is that the control of the buyers that were there yesterday are not here in this session, and we could really kind of go either way. Now, overnight, we had gone and tested weekly or monthly VWAP, so that's good. A thing to watch early will be, can we get back above the Euro IB high and stay inside the prior range? The more likely we are in the prior range, it increases the probability we're going to go up here towards 60.91. But if we're outside of that range, we're increasing the probability that we're going to go tag this naked point of control. So we really kind of have two key directions that we're looking for. Now, whenever the auction opens, counter to my pre-IB bias, and that's what that means is like, who do I believe has control before the initial balance sets? Well, right now, it was the buyers, but being below 60.82, that puts it in the seller's hands. So what we're going to do is we're going to go forward and wait for some more confidence. It's a good clue to just be like, you know what? I'm out of flow with this market, and So I need to see, make sure that this is not going too fast. I need to see either those buyers reaffirmed or I need to see the IB complete. So we're just going to kind of play this forward at 15x and see kind of how this thing develops. At the moment, I've got destinations in mind, right? I've got, retest a monthly VWAP. I've got that 6029 that could be in play. And then I have that 6091 above. So this is kind of the first question of like, where do I think the auction's going to go? It's going to go to one of those two prices. We're in kind of a neutral spot right now. So I need to wait and see, where's the conviction going to be before I step in. Oh, good question. So you'll notice that this is a 20-minute time frame. It's really not. I mean, I'm looking at 30-minute profiles. Just in Motive Wave, I have different time frames based on what tools I want to see, like things that I want to hide. So if I want the chart cleaner, or if I use the 30-minute, I don't see the overnight stuff. So on the 20-minute, I see the overnight profiles, and I'm always looking at the overnight profile, because we trade products that are in 23.6, right? And like here, where we're opening, where's the developing point of control right now? It's 60.65, and we can see that there was a big sell overnight, kind of based from today's close, some impulsive selling that got us below the weekly VWAP. So at the moment, I mean, outside of the first hour or seeing a real directional move happen, unless I can get above 60.80. All right, let's pause it here for a second. So right now, we're back inside the prior range. That's good. Not really a directional open here by any stretch of the imagination. This is pretty tight so far. So, the question will be, what's it like in the next 15 minutes or so? So let's keep rocking and rolling and watching. Like the fact that we're back and forth across, we spent most of the time inside of that 30-second opening range. Like that's not really showing us much of anything. Now, it is good that we're above Euro IB high. That's a good start. But we essentially have an open auction open here. So that just tells me I'm likely going to wait until I see, like, can we get above 60.80? Can we get above that weekly VWAP? If we can, then we've got something in play there. Boring, isn't it? It's really not fun when you like want action. But the reality is there's not always good things to do. Not every price is actionable. And I know it's really sexy and attractive to be active, like right off the gun. The reality is, unless there's strong directional conviction, that is the best way to blow yourself up. Okay, so let's pause here. So we have the initial balance set. We have an open auction in range. And what does that mean? It means basically in A and B period, we have some overlap of more than 50%. What does that tell us about the participants? It means that no one really has a strong conviction here. And that means I don't have a strong conviction because I'm not pushing this market. I'm going to let somebody else drive that thing. So now what am I looking for this thing to do? If I take out IB high, okay, I have the potential for a playbook trade. We already identified pre-market that the 6091, the prior point of control, is a really good target. Now, when the IB extends, the question is, are we going to go with that extension, or are we going to fade it? In this case, we would look to go with it because we're back into the prior range. And if you're inside of the prior range, okay, the longer you accept inside the prior RTH range, you're looking at about a 70% probability you're going to tag the point of control of that prior session. So every bit that we spend inside of this above yesterday's low increases the probability we're going to go here. All right. So now we just got to find these buyers at the IB, and then we can rock and roll. Okay. I do see now this little flash of green here. That is some buying imbalance. So I have it set to, it's basically like layering a footprint on here. So I can see a impulsive buyer step in. So at this point now that we kind of know a little bit more about what we're trying to do, we're going to jump over here to a 15-minute time frame. And we're going to get a little bit more information, okay? And we're looking at, and we're gonna get this loaded, ready to rock and roll, based on a breach of the initial balance. Now, I do have a playbook trade. One of the playbook trades is what we call a structure cleanup. So a structure cleanup is when you believe there's an anomaly in the market that needs to be repaired. And by the way, the way that we get paid, or what specific edge is within a market, it really kind of is in two places. So one is risk premia. And that is where you can establish a position that basically the market's paying because it doesn't know how to price something or has imperfect information. The other place is there's anomalies structurally. Now, those anomalies typically do not last. But while they're there, they can be exploited. So, what we're doing here is we're looking at, there's an anomaly that we have yesterday's most traded price that wasn't tested. We haven't seen if that's good or not. So that's an anomaly we're kind of carrying forward. But I would typically be long here. However, I've got weekly VWAP right in the way. So I would rather have a little bit more confirmation and get above that weekly VWAP. Then I'm going to feel really good about pressing for that 6090. Okay. So let's see if we can get a push up to that area. And here's the deal with these random, I don't remember if and when this extends. So it could be a while. So we'll speed this up. So we're just watching at 20x just to kind of watch this thing develop, see if it tips its hat one way or the other. Now, in this specific instance, we did check and see what, that it was pre-FOMC. When it's pre-FOMC, and depending on how hedged the market was, that can definitely mute activity. And this is definitely good. I mean, this is seeing some buying stepping in. Okay, now we can slow down. We're getting close. It's not helpful. Okay, now we have IB high extension. So we got confirmation that buyers are in control. So how can we play that? Let's now get down to like more of a real time. We'll go 2x. Where's our destination? 6091. We've extended the IB. We've hit the weekly VWAP and then pulled back a little bit. So in this case, again, I want this thing outside of the initial balance and above that weekly VWAP. So I'm just going to start with, they got to get above that weekly VWAP again. So the first tap, fine. Or the other place that I'd look to enter would be right back in here. Why is that? Oh, hang on a second. We don't want minis or micros. We want minis. Okay. So this is essentially an IB, so go with on a pullback. So we've extended the IB, we've pulled back to developing value. I have high confidence as long as I stay inside the prior range that we will not only get back outside the initial balance, but we'll push towards that 6091. But it may take a while to get through that weekly VWAP. So, you know, I can buy at value on that pullback, still looking for that same target, and I can add to it if we get acceleration up above that. And what I'm going to do is, if we get up here, I'll take part of it off, but then I'm going to add if we get back above that weekly VWAP, because that's the spot that is. So I mean, you heard me reference that quite a bit. If that's not part of what you're looking at, if you're not looking at like a rolling weekly VWAP or a monthly VWAP, I'd highly encourage you to do so. Your competitors are doing that. They know where those prices are. So I think it behooves you to know where those prices are. Okay. Let's speed up this show here. Now we should stay above ETH VWAP. We should stay inside the prior range. If we don't, then that's a clue that, hey, maybe I'm not right, and I'm gonna stop out and then reassess. Because these are references that they're fine if they go and and test them, but I do not want. Okay. So, initial entry here at 6071, we were essentially looking for 6091. That's the actual target. And we stopped at a reference that should hold. And it did not hold. It says, hey, we need to wait. So at this point, now it's kind of back to the drawing board and see, if there's another opportunity. Now, if we go neutral, if we take out the IB low, that then, especially putting us below the prior low, that can open the door to run towards 6060 and beyond. All right, so let's keep carrying this forward and see how this goes. we're eating into that buying excess that we had. Now we'll see if that's enough to like hold it. Notice also there I have a 5 daily SMA. I mean, that's an institutional reference. That like 5-day SMA is a kind of a multi-session swing. A 20-day is more of a positional, because you're kind of looking at weekly, monthly types of references there. Okay, so we tested that prior low and are back above the ETH VWAP. So I'm actually going to re-enter. So let's, same target as before. And then I'm defending the low of this period. I'd like to see strong period delta here. We don't have that. We just don't have it yet. The last strength from a period delta standpoint was back here before the open, or actually right on the open. So that is holding, at least that's good. This is definitely one of those days where you're between a bunch of references. It is not easy. Gives you lots of false signals. Now, if I get stopped out here again, then I'm on the sidelines unless we actually get back outside the initial balance. Because that's the spot that's clear. This area, I don't have references. That's the clear field that the market can really move. Inside of all of these references, there's fight, right? Like that's what happens. So that would be one takeaway is, if you find yourself opening amidst a bunch of different references, it's a great time to just be like, hey, I want to stay out until I get into some clearer areas. Now you notice that the TPO chart now it's yellow because we've now gone into lunchtime. This is a period where we've got diminished volume. If I'm not already in a position, unless it's a trending day, I will not take opportunities. But I'm in the position, so I'll defend that and keep going. We'll see if we can break out and rock and roll. Okay, here's some buying deltas coming in. This looks good. If this holds, we'll see if these buyers can hold. Yeah. Still, you can see that just how we come up to that weekly VWAP and then back off, and we're just fighting, just fighting references. And these red lines here, that's basically selling imbalances from overnight. So we're going back up into those sellers from last night, and they're re-engaging. Okay. All right, so now we're just flat. It's during lunchtime, so we're going to need to go forward. I still have this order if we can get outside the initial balance, but unless we get outside the initial balance, I wouldn't do anything. I would just wait. Must have been some kind of release or something, because you can see the R vol spiking here. Now we're neutral. So what does that mean? That means that the buyers that we were leaning on from IB high extension are now gone. This is further confirmation of what we'd already experienced, is that there's just not strong conviction here. And again, going back out to kind of where we are out here, I mean, we kind of watch if we can get outside of the IB low, because this now tips the scales to the sellers. We could look for monthly VWAP and 29. We'll see. But unless I went back above IB high, we'll see where we are after lunch. Now, notice that there's a poor low here, or unfinished on this TPO. So same kind of deal is if we can get outside you got the weekly mid, you've got monthly VWAP, like yuck. So this is, okay, great. Let me pause here. So what did I do? So this is an IB go with on the other side. And that can happen when you go neutral like that. We had a tight initial balance, and that break that we were looking for to the upside came with tempo to the downside. Now, how do we know that there's tempo there? Is that we've got elevated relative volume and we had strong period deltas. And you'll find trade's going to go a lot more in your favor when you've got strength aligned with you. And those are ways that we measure strength. Now, notice I went in with 3. I peeled some off at weekly mid. I peeled some off at the monthly VWAP. Why? Because these are both references, especially in the S&P, that are going to be reactive as they were. So, I've got one runner. If we get below the monthly VWAP, then this could be turning into a trend day. So we weren't trending, but if it becomes trending, then that could be a trend continuation short. And then I know where I'm looking to get to. But if we get back inside the initial balance, then we're likely going to go up here because we're a neutral center day and we're just going to rotate back to value. So I would cover the one, and then that would be another playbook trade, which would be an extension fade long. So if you extended the IB and then you fade that, if we're unable to hold out here, you're going to go back to value. All right, so let's see how that plays out. Now, as far as stats go, okay, so we've gone neutral. The probability that the S&P specifically is going to go neutral on any given day is about 30%. Okay, let me pause this. Pause. So now we're below monthly VWAP. We do not want trade above that. So that's where our stop's going to be, okay? This is now looking more like a trend day. We're out past 1.5 the IB. We're approaching 2x. We also just completed the overnight stat. So if we can print another TPO out here, that's really increasing the chance that we're going to go down here and clean that up. Okay, so let's keep playing with that. right, we're back above the overnight low, so we're just going to hold on for a second and see if we can develop. Now the extension fade could still be in play if we can get back inside the IB, but right now we're focused on a trend continuation. Oh, shoot, that was too fast. Should probably not do this at 20x. That's that's a little too fast. Oh man. Pretty strong buyer that came in right there, right in front of the prior week close. Again, this is one of the reasons I don't trade the SP. It's so like you have to know where all these references are, because it just like it goes to that next one and then the next one and then backs off and then the next one, and then we're not even looking at Gex levels in here. So that's another piece of that puzzle. So notice a little bit trying to build out down here. So now we potentially have a double distribution trend day. So as long as we stay south of here, that should be the destination, which we were looking for that 60-30 pre-market, right? We knew what that reference was that we were looking for. Yeah, sellers are trying. Yeah. Come on, gang. Haven't quite got there yet. Well, we can stop here because we're running out of time. I want to get to some other questions. So, here we are. We started. We had, a narrative and a plan. We also know what might challenge that, and then you let the structure tell you what to do with that. What's so helpful about that is that helps your brain not stay so committed to something that you can't adjust to where the real opportunity was. Like we came into this, this session, and we really felt like, hey, if we're above 60.81, like the opportunity is up to 60.90, plus. It turns out that the best opportunity and the best movement happened with the break of the IB low, the acceptance below the prior range via basically the same setup. The IB go withs, we're going with that breach of that IB, and then turns into a trend continuation. And then respecting those references where there might be reactions kind of helps us know, how to stick in that trade. Okay. So with that, let's jump over to some other questions that are out there, and then we'll see where this should take us. Okay. And again, next week we'll do the same thing. Okay. So here are the pre-submitted questions, and then you guys have had some other ones. So here's the first one. So as a trading addict, traded without a plan, failed 190 evaluation accounts, how to start trading again and not repeating the same errors. So, this is a great question, and I can certainly, connect with that experience and that pain. I don't think that you're alone in that. How do you start over with that? So one is to try to identify an opportunity within the market that ultimately is going to become your anchor trade. So, I don't know what what you've necessarily been trading to try to, pass these evaluation accounts. But, first thing is, were those trades 4-question trades? There's parts of the dynamics of those evaluation accounts that are really built around the idea that the risk is such that you're not going to do well. It requires, good discipline in a framework like a 4-question trade. So first answer would be, go back and look, were those 4-question trades, or were those, hey, I just need to be active, or I'm just trying to pass this stuff, right? Then your next step, if it hasn't beat you up too much and you want to go on and try again, is to determine what your playbook trade is. So all traders need an anchor trade. They just need one setup that they can express over and over again, that they know in and out. And I would say, like people that work on our team, I share my playbook and I say, okay, go practice these. Get 100 instances of these and find out which one you think is your anchor trade. That's the one, once you have 100 instances of that and that has positive expectancy, doing exactly what I'm doing here. Like you're replaying old markets and you're playing it in forward, time as if it's real, and you're tracking that performance, and you find out that that's where your anchor trade is. That's the one you go live with, or that's the one you'd go back to a funding account with. But that's the work to do that. And if that's not work that you're interested in doing, it could be that trading is not for you. And I would advocate that everyone who thinks that they might want to be a trader, put in place a poison pill. And what do I mean by that? It means that there is a definitive line in the sand period of time that if I have not seen X performance by this date, I'm just done with markets. It doesn't mean that you can't be an investor, but the whole idea of being a day trader or, passing these funding programs it's just not for you. And that would be a wonderful revelation. The opportunity cost of years and years and years trying to get towards this and not succeeding, unfortunately, while there are always exceptions, right? Gang, there's always exceptions of someone who they cracked the code after 10 years. They're the exception. They're not the rule. That is not stacking probabilities in your favor. If you're at 3-4, you're 5, you're 6, and you're still not getting where you want to be. That's not increasing the probability that you will succeed. So those are some things I think about with that, right? Second question. How do I calculate the expected range for the S&P, trying to get independent from the quick sheet? So when they're talking about the quick sheet, so this is a tool that I generate for myself and others every day, that just represents a couple key things. One, the posture of a market, prior day type, and then you'll notice here expected range, weekly range, expected range, monthly expected range, and where are we relative to those ranges? Where do these come from? So all of these markets are driven by the derivatives. So the tail wags the dog. So an expected range is really based on the implied volatility of that product. We throw that into Black-Scholes, and then we generate an expected range out of that. That math is freely available. So, but what you need is you need to have the implied volatility, and you have to have the prior day's close. The real quick equation is implied volatility percentage times the square root of 1 divided by 252 would give you the expected range of the next session. And that would be, if you want the expected range high or low, it would be relative to that prior close. And if you want it for 5 days, you put 5 in there. And if you want it for like a month, you'd put 27 in there. And if you want it for a year, you do 252. Like you literally can take the current implied volatility and build an expectation of what the range will be for the next year. And that's not just like that's based on where people are actually positioned. So it does actually carry weight. It's not like a moving average or an average trading range. Those are describing what happens, and an expected range is looking forward to describe where we're going. Okay, next question is around posture, and this is also represented here in the quick sheet. If you're not familiar with the idea of an auction posture, I've got a YouTube video that you can go Google that'll just kind of walk you through it. I'll give you a quick snapshot of what I mean by a posture. So anytime I start with a product, there's like absolutely any product out there, there's really three references that define context for me. And that is the last price, there's the most traded price of the last 5 sessions, and then there's the most traded price of the last month. And where is price relative to that is indicative of where we're going to go next, and what my general trade and narrative plan is around this stuff. Okay, so if these are all equal to each other, then that's a balanced market. All moves begin from balance. If we have price 5-day, 20-day, then that likely is going to look like this on a composite profile. And it means that we're running out of participants as we're going higher. Does that mean that we're done going in that direction? No, but it means that I'm going to be really, really, really cautious about taking any positions in that direction. Amongst these 3 variables, there's about 9 orientations that show up over and over again. There are a couple weird anomalies, but by and large, this is the case. I look at where that is the last day, and then is there, can something change in the next session that would change what that posture is? So like, let's go look, for example, at, let's look at the ES. These are live markets. Okay. So here is price, 5-day, 20-day, 90-day. Okay. Why do I believe that, the S&P is going to struggle to go significantly higher from here? Because especially if you look at the longer term profile, we're running out of participants as we go higher. And auction theory would say, hey, it's going to be really challenging to go higher if you don't have anybody to go higher with. So, my expectation typically here is that we're going to either go sideways or we're going to go back at least to the 5-day. And that's what I believe and how I think every time we have a product in this orientation. Okay, so if we go back to that question, so think of that. Yeah, I'd have to go look at that specific one. So typically traders that are looking at posture get tripped up on like what represents a different posture. And, I would say you got to have at least 2 expected ranges between those references to have any type of separation. You can always look at the quick sheet. Okay, I'm looking to make the IBGW, IBGP set up my anchor trade. Yes, great. That is a wonderful goal. That is fantastic. And as they've said, there's multiple execution criteria. So yeah, on a playbook trade, there's lots of criteria. Let's look at, for example, an IBGP in the ES. Yeah, here's one. Okay, so, all right, notice that it has a playbook score of 9 out of 10. So these are all criteria that can inform, hey, this is a great go with on a pullback trade. Now, I don't think I've ever seen a 10 out of 10, and the mix of these are not always the exact same. Here's a challenge, and it's often a challenge, is that when you're looking to express anything, it's never going to be perfect. So, there's always going to be a dimension of, I don't know how this outcome is. Now, I can build greater confidence by there being more of these pieces in place that give me, the higher that score is, the more confident I am in that. And so, when I think about, these with any playbook trade, the first criteria is that it's going to be the driving input is there, right? So if I'm an IB go with or got pullback, I've extended the IB in that place. Probably the next second one to that is how wide is the initial balance? How much expected range is left in the day? So if I've got more bullets that the market would offer me, more likely that I'm going to get excursion in that direction, and so I'm more likely to do that. So outside of that, I'd say look at more of those decision criteria, and then you could be in good shape. What, like profile imbalance. So this idea of skew here in the profile. So that would be like if I had a profile and I see it like this, right? So I'm imbalanced. A profile is just a bell curve, right? So if I'm imbalanced like that, that's, as so long as I stay above here, likely going to get expressed that way. That's just working out the equilibrium of that reference. Can you explain the 3-rev trade? So three period, it's basically a third period reversal. And essentially the idea is that, the auction has moved and you get to the third session and it's more likely going to, so you could have a directional day, move a rotational day in the direction. This next session is more likely to see some failure. So if I, open, push above and come back inside, then I'm going to look back towards like that next point of control or some composite node. That's a third period reversal. Okay. Let me throw some of these other questions in here and we'll cover them briefly. And great questions, gang. Keep coming. Wait a second. Why is this? It's not getting the right one. Why is it not copying that? There we go. Okay. Does the target need to be at least a set minimum amount? It needs to be, I like to look for, within a playbook environment, I want something that from where I enter offers me 3x the risk. So if I identify an opportunity that, like we were looking at that, 60-60, we're looking at 60-90, we're looking 30 points away. So, 10 to 15 points is a reasonable risk around that. So I'm looking, and when my style, I'm not interested in ticks. I'm looking for points. In terms of like a trading day, my goal is to capture 25% of the expected move on a given day. So, if the NQ does 200 points, what's 25 points of that? Or 25%, that's 50 points. That'd be A+. That's very reasonable. And so that allows you to express and expand based on what opportunities there. Do I have any opening swing playbook trades, or are I usually gathering info into the first period? No, there are trades on the open. So there is they're all under the idea of a directional open, but we have an open auction go with, or open auction outside of range. There's an open test drive go with. There's an open rejection reverse go with, and an open drive go with. So if you see, this would be if we gap. So if we have a gap and the gap holds, I'm going with the gap. This would be that we would open and we put in an open test drive open. So you open some, you test a reference and then drive away from that with velocity. Open rejection reverse, typically that's in B period, but we've opened, we have some excursion that looks like it's going pretty good, and then that reverses with velocity. And then finally an open drive, and that's where the market just like opens and goes. Do not pass go, do not collect $200. It just rocks and rolls. Those are all early pre-IB setups, but I have to see those opens in play. Are there any stats associated with monthly VWAP or weekly VWAP as a daytime reference? Or sorry, other question. So this is MotiveWave is the platform that we're looking at here, motivewave.com. Are there any stats associated with monthly VWAP or weekly VWAP? So I guess what you're looking for is like I mean, there are different ways you could express that question. You could say, within an intraday time frame, if I test one of those references, what's the typical excursion in a reactive move away from that? The tricky piece is that you're going to have to go down to you're going to have to pick a time frame of what represents acceptance or rejection around those prices, or is it I'm looking to get to that price as a reference. So I'd have to know more about what you're specifically looking at around that. How to avoid analysis paralysis when it comes to playbooking, or some reference or new knowledge that comes to light this journey. And see, I developed a playbook trade. Okay, so this one, here's what I can tell you about and this is why I look so much at things in the initial balance. So if you pick even like an opening 30-second range, okay, there's literally no edge that's more than a 50-50 bet until you get to an hour. So pick a range, pick a 30-second, pick a 1 minute, pick a 3 minute, pick a 5 minute, pick a 50. I've heard them all, right? You will not have anything that's more than 50-50 in terms of once I've gone past this one now, there's more probability that I'll go in that direction than the other one until you get to an hour. Once you get to an hour, and why does it work like this? Because 80% of the volume of the session still is in that first hour. So once that's gone, you need firepower to go the other direction. You likely don't have it unless there's some kind of catalyst, which is typically what happens when we have neutral activity. So, if you want to do something early like that, for one, just know, hey, there really is no, once I'm past this, the odds are in my favor. They're not. I'm sorry. They're just not. But can they be used as a meaningful reference for risk? Absolutely. Could they also be used to say, let's say the 30-second opening range, how many times, the more times that I go neutral across a reference like that, the less likely I am to keep going neutral across that, if that makes sense. So let's take and when I talk about the opening range, I'm always talking about the 30-second. So if you want to talk about anything else, you say, hey, the first 1 minute, I'm looking at the first 1 minute range, or I'm looking at the first 3 minutes. Institutionally, we would always talk about the opening range is 30 seconds. That's what the CME marks. So, but let's say that the opening 30-second range, I'd say, okay, I took out the high of the opening range, so I'm defending opening range low. So we take out the opening range low, and then I go back above the opening range high. I'm more, that's telling me there's more buyers there, that I was able to get back above that after I went back through it. But you can be, watch out, because there are days when you just washboard back and forth across that thing, and that thing's going to rock and roll and eat your lunch, and they can be really, really damaging days. So, I would look for all kinds of other criteria around whatever I was looking. I specifically, I would not do anything in the first hour that I would consider a fade. I would look at it as, here's the place that the auction couldn't go, and now I'm going with the participants who are going in the opposite direction of where that could go. I don't think that it would be helpful to call, and I have mad respect for Linda, but I would not go with anything and call it a fade if it's not after at least the first hour. So that's just my 2 cents. You are welcome to do with that what you would like. All right, we got time for one more. We're a little bit over here, gang, so thanks for your patience. Okay, last question. I find it hard to imagine reaching a level of consistency where someone doesn't have a single losing week for years. I assume the key to that must be the ability to adapt quickly to different market cycles. So yes, you're imagining that correctly. That'd be very rare that someone would not have a losing week. Like you're gonna have losing weeks. Here's the deal around those is if you're managing your risk well, you can have losing weeks and yet not blow your account up. So like I had my first losing week in years a couple weeks ago, or maybe it was a couple weeks ago, and it only took 2 days of favorable market excursion to make up for and surpass that week. How does that happen? It's because the risk is so tight. Like I know where I'm wrong and it just didn't work out. And whenever you get stopped out, you go back to those 4 questions and say, is there a 4-question trade here? What would have to happen to trigger me into that trade? And if there's not, then you take your lick and you wait for the next playbook trade. So the first piece is the key is not adaptation. The key is risk management and clarity around your playbook trade. But then the second piece is, yes, like how am I adapting around my playbook criteria? So like I was talking to a trader, we were doing an audit earlier this week, and he had been doing really well. And then what ended up happening was he's like, all of a sudden he's like, it's just not working. So at that point I said, okay, well, let's think about what's changed. Is there anything that's changed? And that's a question that when these things don't work out, like that's the thing you can go is like, is there something that's changed recently? One thing to ask is, have we moved into a market cycle? There's different market cycles. There are vol cycles, meaning that volatility has changed. That could be driven by seasons of the year when there's more uncertainty. It could be driven by geopolitical or policy stuff from a government. There are also times of the year that impact that around, are we in summer? Like the period from June OPEX to SEP OPEX, or really to August OPEX, like nobody's home. And they're just like, you'll see like little liquidations and they immediately get bought. Like nothing gets good follow through. And that's a season period, or there are periods when we're in a monetary market versus a fiscal market. What's the difference? Monetary market, the Fed is basically put their wins behind the sale of equities. It's really easy to do one-sided trade. When it's not doing that, like the market that we're in right now, it's a fiscal market, and you get more two-sided trade. So first is risk management, because that's something you just got to have any season. The second is, hey, if all of a sudden I start to see a deviation in my performance, is there a time piece? And just like there's not every price is actionable, not every time is actionable. Okay, so understand that. How can a developing trader prepare for that kind of adaptability? Time in the saddle. And knowing your anchor trade and getting as many instances as you possibly can historically, and then going forward as fast as possible. Is there any way to develop that kind of adaptive skill without needing to go live through every type of market regime over 20 years and nearly blow up with each transition? I mean, yes, like use market replays, go trade those things back. I mean, you can think about this. If you identify, here's a playbook trade. Well, let's just look at like a trend continuation trade. So you can go back and you could look at prior markets and you can identify trending days where you can go, okay, that was a trend day. This is a trend day. This is a trend day. This is a trend day. Okay, great. So then go back and trade all of those looking for that trend continuation. And you could get a whole mess of trend continuation playbook trades in your wheelhouse really, really fast. And then that prepares you to go forward. In everything that we're doing, and this is the place that I'll leave you with, is that we're always essentially there's essentially 4 stages that you're trying to get to. So there's in the development. So there's stage 1, stage 2, stage 3, and stage 4. Now, stage 4 is where everybody wants to get to. That is the place where I can operate and it just looks like I just know what to do. It's a unconscious competence. So unconscious competence. It's a honed instinct. It looks like someone's operating from instinct. They are, and that is because they've honed that. What's on the other side of the spectrum is an unconscious incompetence, meaning I don't know what I don't know. And that's a dangerous spot, right? If you're trying to operate within markets, you don't know what you don't know. That it unfortunately plagues a lot of market participants or people that want to be in markets because there just isn't readily available information that you could trust that's out there. But let's say that you realize that there's stuff that you don't know. So then that is a conscious incompetence. So like, I do know that I don't know. You can really do that is the best place to be, because that means that you're curious and you're open to new information and you're willing to try things. And in the whole development piece around trading, you're moving from stage 2 to stage 3. So stage 1 or stage 2 is conscious incompetence. Stage 2 is conscious competence. What does that mean? That means I know what will work. I can trust that system, but I just don't have enough reps yet. Now, this is where you can see the most significant movement in your development in a short period of time, is from stage 2 to stage 3. Now, once you get to you're at the end of stage 3, you would maybe have identified an anchor trade. You're like, hey, this is my anchor trade. These are the trades in my playbook. I know what inputs matter to the market and which ones don't. Okay. I've got that stuff down. Then your job is to get reps. So you're compounding all of this experience and just doing as many reps as you can. And that's how you get to a place where it's an unconscious competence. Like you're like, oh, I just know. Like I don't have to go through the checklist of, is this a playbook trade or not? It's just, I just know because I've seen so many of them. Okay. And this is very different than people who will say, well, I just need time in the saddle. The problem is that if you don't know what to trust, time doesn't really help that much. Now, time helps a lot if you know what you can trust, because then I'm just getting reps. I'm just getting reps. It's like, if you've ever been in sports or you've been in the gym and you see somebody, you're like, that person has been in the gym for decades and their back is now all out of whack. They're not in any better shape than before. And yet they're here a lot, versus here's somebody who's come in here. They've been in here 3 months and they've transformed their lives. Like, what's the difference? One had a plan and they knew what to trust and they knew how to get the results and they went after it. The other person is just like, I'm just showing up and, I'll get some kind of results. You're going to get a result. Is it the result that you want? All right. So that's how I think about that question. So thanks for the questions, gang. Couple next steps for you as we land the plane here. One, go back to those 4 questions. Ask yourself, how good am I at predicting where the auction is going to go? And do I have data to prove that? And data doesn't necessarily need to be market stats. Data needs to be your execution of those market stats. Okay? That is so key, because if I know and have high probability in the destination, then I can get to the next spot, right? And then what would happen if I use the 4 questions to define my trades? So if you're not doing that, man, please, let me help you. Let me give a gift to you. Go back and define your trades as 4-question trades. If you're not sure if you got something that's a 4-question trade, like take a bunch of screenshots, do a write-up, and email it to me, and I can give you some feedback. Okay, but get them into a playbook trade. Get them into a 4-question trade. If you want to be around a community of 4-question traders, we have a Discord that is free and open to anybody. I'm in there most days. I'm not like posting stuff all the time, but trying to provide enough, framework in real time of what's going on. So get on that if you're not. And then, if you really want to accelerate stuff and you're not really sure where to go next, and should you do some more deep dive or whatever, I set aside time every week to do one-on-one insight sessions. So it's 30 minutes. It's free. There's no requirement beyond that, but bring a problem. We'll work on it and see if that helps. The only caveat on those are because I'm doing them for free, you absolutely have to show up. If you do not show up exactly at the time that it starts, you lose the slot, and I will not schedule you another one. So like, this is purely for people who literally are like, I want to work on a problem. I got my crap together. Let's go after this. Don't waste my time, because there's somebody else, I believe, that would use that 30 minutes to go forward. Okay. So that's it. That's my spiel. Thanks for hanging out with me. And I hope that this has been helpful. We will post this on the tube of you, and we'll be back for another Q&A soon. All right. Peace. Thanks, guys.